Hello, in this lecture we will continue on chapter 23 discussing computing material and labor variances. So we're going to move on to labor variances in this lecture. It's going to be similar to the calculation for materials variance, just that we're going to apply, of course, the components for labor. Instead of price and quantity for direct labor, we use the terms rate and hours. So we have a similar type of analysis here, and we have the same idea that the total variance is going to have to do with total wages. We can break that up into its two components, being, well, what happened if the wages were higher than we thought they should be? Is it because of a rate difference, meaning we're paying more per hour, or is it because of an efficiency difference, meaning it's taking more hours than we actually thought? So if we do the same type of calculation, we see that we can compare the rate variance, which we can keep the actual hours and constant through our calculation, and the rate is the thing that changed. So we're going to change the rate here. So if we take the actual hours times the actual rate and subtract that from the actual hours and the standard rate, that gives us our rate variance. If we compare that over here to the efficiency variance, then we're going to take the actual hours and the standard hours. Those are the things that are going to change. So actual hours times the standard rate compared to the standard hours times the standard rate. Now, the thing that has changed is the rate. What is the rate that we actually paid compared to the rate we should have paid? And then, of course, if you add the rate variance and the efficiency variance, that will give us our total variance. Then, if we think of the shortcut way to say that, the rate variance could be the actual hours times the thing that changed in this case, which is the actual rate and the standard rate. So the thing that is different here, that will be a shorter formulaic way that we can calculate the rate variance. And the efficiency variance, then, we can take the thing that's the same, the standard rate, times the actual hours minus the standard hours. That's the thing that is different. That'll be a shorter way to calculate the efficiency variance. So if we take a look at our example again, we have the same example, produced 3,500 club heads, working 3,400 hours, paid an average of $8.30 per hour. So if we break this out into our formula then, and we're going to calculate the rate variance, we're going to have the actual hours times the actual rate, and that will give us our 28,220. If we plug those numbers in there, we're going to compare that to the actual hours times the standard rate. And of course, the thing that has changed in this term is going to be the rate here. So the $8.30 compared to the $8 gives us, in this case, an unfavorable difference, meaning that we're paying people on average 30 cents more per hour, and that's going to give us this difference based on the fact that we're paying more than we thought, as compared to the efficiency variance, where we're going to take the actual hours times the standard rate and compare that to the standard hours times the standard rate, the thing changing now being the number of hours that it took to do this, and the actual hours here are less than the standard hours. So therefore we have a favorable difference because it took less hours to do this, to do the work, but we have an unfavorable rate variance. So now we can try to think about the explanation of that. Labor cost variance, evaluating labor cost variance. One possible explanation, labor rate and efficiency variance, is the use of workers with different skill levels. So we could think about, well, why would this happen? Well, one, if we use highly paid skilled workers to perform skilled tasks, unskilled tasks result in an unfavorable rate variance. So if we're using our workers inefficiently, we're using highly skilled workers that, assuming will be paid more for tasks that do not need their highly skilled abilities, then the rate might be too high on the rate variance. However, fewer labor hours might be required for work, resulting in favorable efficiency variance. On the other hand of that, then, the idea being if we hire more skilled labor and more highly trained labor and pay them more, then it could pay for itself in that the cost of hours could go down because they supposedly would do a better job and do it hopefully more efficiently. And so we have the same kind of argument that could take place. Who is responsible for material variance? Production managers who make work assignments are generally responsible for labor cost variances. So this individual is saying that I'm not responsible for the unfavorable labor efficiency variance you purchased cheap materials, so it took more time to process. That could be an argument that ends up happening. So if the materials are not up to par, then when we produce when we do the production, the argument would be then that it took more labor to work with those materials. And then, of course, the counter argument would be you use too much time because of poorly trained workers and poor supervision. So when we take a look at an unfavorable variance, of course, we're going to go to different departments, and different departments are going to have different outlooks in terms of why that unfavorable variance is taking place. So now we're going to take a look at computing overhead cost variance. So overhead statement and variances. Recall that overhead costs are assigned products and resources using a predetermined overhead rate. So remember what overhead is. It's all that stuff that is in the bucket that we're going to have to apply to the production process, and we're going to do that through some type of allocation. Generally, we do that with a predetermined overhead rate. So things like depreciation, things like utilities on the plant, things like small materials and whatnot that go into the production process. We put that all into one bucket, and then we apply that out using our predetermined overhead rate, which is calculated as estimated total overhead costs, what we think the overhead should be, divided by the estimated activity. And that will give us our rate that we will then use to apply out. So assigned overhead is the predetermined overhead rate then times the standard activity. That's the standard rate that we're going to use. Now, there's some problems with this type of calculation. It's useful for us to do this and then calculate what we think the predetermined overhead rate will be. But the problem with overhead is that when we calculate this, there's going to be costs in there that may be fixed, and there's costs that may be variable. And we know that they behave differently at different levels of activity. So this rate, as levels of activity change, do not change, as we discussed before, in a flexible budget in the way we would like. And so we could do some analysis on that in order to try to break out the fixed portion and the variable portion of the overhead. So to allocate overhead costs to products and services, management needs to establish the standard overhead cost rate. So that the standard overhead rate, function of activity level chosen at a determined rate. So we're going to have the standard rate, and it's going to be at a certain activity level. So it contains a fixed overhead rate which declines as activity levels increase, and it contains a variable unit rate which stays constant at all levels. So that, of course, is the problem, that when we come up with one rate, then that rate is having two types of costs in it that behave differently as activity levels change. So flexible budget showing budget amount of overhead for variable levels of activity are used to analyze overhead costs. So if we want more data on this and we want more detailed analysis, we're going to have to break out the variable portion and the fixed portion, something like this. So we've got the variable amount, we're going to say, is $1 per unit. We have different levels of capacity in terms of the production in units. So here's the production in units, and 5,000 would be at capacity, meaning that's how many units we can produce. Now, if you think about production in capacity, if we're thinking about things like paying rent on a location, and we make like guitars or something, and we're saying that we can make 5,000 guitars, that's the max we can make in that capacity. But obviously we're probably not going to be producing at capacity all the time. You can think of it as similar to if we have a restaurant that, to fill the restaurant and have everybody sitting at every table, that would be their capacity. They can't really go over capacity, but they're usually going to be somewhere under capacity. If we think about production, then of course we have the same type of thing. We're going to produce what will be bought, and therefore we might not be producing as many as we possibly could be producing. So if we think about the variable cost, then we're saying they cost $1 per unit, and then the total fixed costs are $4,000 for any set production. So now we can break out the variable portion and the fixed portion. And if we just picked a level of production, say 80%, then we could break that out to basically $2 per unit based on this calculation. But of course, again, as the production levels change, that $2 will be distorted by the fact that the fixed costs are going to go down as we produce more in capacity, because they stay fixed no matter how many units we create. So if you think of a restaurant, of course, the more people we have in there, the less the rent is per person in the restaurant. as opposed to if we think about we're serving one meal, the meals go up in proportion to how many units are in the restaurant. So if we choose that rate, then the standard overhead rate would be the 8,000 divided by the 400 hours, or $2 per labor hour. So this standard overhead rate will be used in computing the overhead cost variance. So computed overhead cost variance, when standard costs are used, a company applies overhead to a unit produced using the predetermined overhead rate. The difference between the total overhead costs applied to products and the total overhead cost actually incurred is called the overhead cost variance, defined as follows. So the overhead cost variance, the difference in overhead in terms of what we thought was going to happen and what actually happened, is going to be calculated as the actual overhead incurred, so we know what actually happened, obviously at the end, minus the standard overhead applied. So, for example, during May, the company produced 3,500 club heads working 3,400 hours. They budgeted 4,000 units, or 80% of capacity. Actual variable overhead was 3,650 and actual fixed overhead was 4,000. So if we take a look and plug that into our formula, then the overhead cost variance is the 3,650 plus the 4,000, giving us our total there, which gives us minus the 3,500 times the $2, which is our rate. That would give us the 7,650 minus the 7,000, giving us an unfavorable difference of 650 for our overhead cost variance. So to help identify factors causing the overhead cost variance, let's analyze this variance separately for controllable and volume variances. So notice once again that we took this $2, which again could change in terms of the level of flexibility, how much we make because of the difference between the variable cost and the fixed cost that are both included in that $2 number. So we could then break down the total variance, what we just calculated, to two components once again, to the overhead controllable variance and the overhead volume variance. Controllable variance being the actual total of overhead incurred minus the budgeted total overhead. Volume variance being the budgeted fixed overhead minus the applied fixed overhead. So if we do that, then we're going to take the actual overhead given, the 7,650, minus the applied overhead from the flexible budget. Now if we go back up to our flexible budget and we looked at the $1, you can see that we have the 7.5 at the 70% for the 3.5 unit level, and we have the fixed portion being 3,005 at this level. So if we take the actual overhead minus the applied overhead, that's going to give us the 150 controllable variance. That's what we think is variable. That's what we think we have control over. Then if we take the budgeted fixed overhead at predetermined capacity, which is 4,000, and subtract out the applied fixed overhead, that 3,005, then we're going to get the volume variance, which is also unfavorable. If we add those two up, it adds up to the 650 that